You'll do the introduction?
Mhm. Hi, everyone, and welcome to today's webinar, Credit 101, Understanding and Improving Your Credit Report and Score. I'm Jolene Carey Pace, the Program Coordinator at the Wilkes University Small Business Development Center, and I'm so happy that all of you could join us this afternoon. And before we begin, I'd like to thank Dorothy Lane, the Director of the Wilkes SBDC, for sharing her presentation today. Just a quick note to please put yourselves on mute so that we can avoid having any background noise. Also, as we go along, you can type any questions that you might have into the chat box. And there will also be time at the end of the presentation to ask any questions that you might have. And now I will hand it over to Dorothy. Thank you.
Thank you. Good morning, and I really appreciate you joining us this afternoon, I guess, for the Credit 101, Understanding and Improving Your Credit Report and Score. As Jolene said, I'm the director of the Wilkes SBDC. I've been here about, oh my gosh, 20 years. That time has flown. And I've worked with a lot of clients in helping them get their businesses started or expanding their business. And one of the most important things that always comes up in discussions is credit score. So that's why we decided to offer this webinar, because especially now with COVID and a lot of businesses falling behind, or even people falling behind in their personal credit, we know that that's become an issue. So we wanted to share some information that we had about not only how to improve your credit score, but to understand it and how it really impacts so much of what you can do financially. But before I get started on the actual presentation, I just wanted to give a little bit of a background about the Wilkes SBDC if you're not familiar with it. So the SBDCs provide no cost technical assistance that is completely confidential to not only business owners, but aspiring entrepreneurs. Our center covers 5 counties. We cover Carbon, Columbia, Luzerne, Schuylkill, and Sullivan counties. But there are actually 16 SBDCs in the state of Pennsylvania. So if you're not located in any of the counties that I just mentioned, I would encourage you to seek out one of the centers in your county that services your county, and they would be happy to work with you. We all offer the same core services. There are some centers that have some specialty areas, but all of the basic services are standard across the state. We are funded by the Small Business Administration on the federal side, and then the state of Pennsylvania through the Department of Community Economic Development also gives us money, as well as our host institution, Wilkes University. And just as a side note, all of our SBDCs are located on college campuses, and that was done very strategically because one of the most important things that we do as we're helping our clients is giving them good information, which involves accessing a lot of research databases, which can be found at these higher ed institutions. So that's why we're there, if anybody's wondering. The SBDCs can help with a variety of services, anything from startup assistance, business planning, capital acquisitions for startups and expansions, lines of credit, anything like that. We can help with guidance for financial management. We can help with marketing and branding, government contracts, international trade, product development, engineering services. And if we don't offer those right at our office, we can refer you to our sister centers who would handle those specialty areas if we don't have them. But these are just the high level. If you drill down within each of those categories, we do handle more intricate areas of each of these categories. So without further ado, let's get started on credit because that's why you're here. So this past year, as I said, with COVID and people struggling with their finances, we decided this would be a really good program for us to present to clients and anyone who might be interested. Um, we've seen more and more of our clients who are getting maybe turned down for the personal the Paycheck Protection Program, excuse me, PPP loans, because they've had poor performance in the past or bad credit scores. Because even though it is disaster funding, you're going through a bank to get that money. So that was kind of the big bell that went off in our heads that, a lot of our clients just don't have those credit scores. So as you can see, credit is the ability to borrow money and then pay it back later in a timely fashion. And, lenders really hang their hats on credit scores, and that's why it's so important. It's important because basically it's part of your financial power as you work through your personal life, or if you're thinking about starting your business. It helps you get things that you need, whether it's money to start a business, whether it's buying a home or property or a car. Credit is important, and a good credit score is important. And if you have a good credit score, it allows you to hopefully access loans. And we'll get into some more things about that. But this is something that I just saw. It popped up in a very timely way on my social media just the other day as I was putting this presentation together. And I thought it was a terrific example of why credit is so important and the implications that it can have long term. So we're looking at two people who are buying the same exact car for $23,000. And the term on the loan is 66 months. So person A has a credit score of 730, which is considered a very good credit score. And person B has a credit score of 599. I've seen worse, but it's not the best credit score. Right off the bat, person A, because they have a good credit score, they get a lower interest rate right out of the gate, 1.99%. Whereas person B has 14.99%. That's a huge, huge difference. And lots of times, I think when people really have a desire or a passion for something, whether it's buying a certain car, whether it's starting a business, whether it's, buying a home, sometimes they overlook those interest rates and how it's really going to affect the overall payment. And you really have to be keenly aware of what your interest rate is. And sometimes you can negotiate those rates, but really your credit score is going to be the most impactful part when you're given an interest rate for something. So as you can see, the payment for person A is 368, per payment B 513, almost 514. That's a difference of almost like $145, $150. That's huge over time. And as you can see at the bottom, over time, person B is paying $9,619 more than person A. So, you might think it doesn't mean that much or that the interest rate isn't that big of a deal. You're just happy to get the car or the house or whatever it was you were purchasing. But think about that over time, how much money you're investing just paying off interest, not even towards the payment of the home or the car or whatever it might be. So keep an eye on that, and a good example of why good credit is so important. So a credit score is a number between 300 and 850. And that indicates your credit worthiness, meaning the likelihood whether a lender is going to lend you money or not. The higher your credit score generally means you're qualified for a lower interest rate. And the higher your score also means the better a borrower looks to a potential lender. They're more likely to take a risk on you. And a credit score is based on your credit history that you have accumulated. And they look at it over however long you have established credit. So it can be a couple months, or it can be many years that you have developed that credit history. And the credit history really involves the number of open accounts that you might have, like how many credit cards you have open that are active. And sometimes even those that are dormant, they'll look at closely too, and what your history with that card was. They'll look at the levels of debt on those accounts that you have been paying on and you have credit with. And this isn't just credit cards, but it's also car payments, any expenses that you might have that you're paying for on credit, like medical expenses, student loans, mortgage payments, anything like that is what makes up your credit history. So you really want to keep good check on that credit history, and we'll talk about that a little more. But the credit scores then will tell the lenders what's the likelihood that you're going to pay them back in a timely manner. So the credit history, the credit score is comprised of a couple of different things. The biggest thing that they're looking at when they develop your credit score is your payment history. That's the factor that most people struggle with is, are you paying on time? So that's one of the biggest thing that they look at is your payment history. Are you paying on time? Are you paying more than the minimum amount? All of those factors go into the payment history that they look like. And that's 35% of your score. So that's significant for sure. How much you owe is the next big thing. Are you keeping large balances on your credit accounts? Are you just paying on the interest, or are you paying down the principal? That's what they want to look at. How long have you established credit accounts for? What's your credit history length? Young people, obviously, you might only have it for a couple months, maybe a couple years, whereas someone my age, has credit for well over 30 years. So they're going to look at the length of the time that you've had credit as well. They also want to see if you have new credit and your ability to take on new credit. Have other people taken a risk on you, and are you handling that new credit responsibly? So they'll look at that. Some things that they'll look at: have you recently acquired, say, a home that was a big purchase? And they look at that two ways. Yes, great, you've purchased this home, you've established credit and a mortgage, but they want to see if you're paying it off well, if you're able to handle that new credit. So that can be kind of a two-sided thing that they look at. It can be good or bad. Then they want to look at the credit mix that you have. They don't want to see a boatload of credit cards with huge balances on them. They want to see, a couple of active credit cards that you're responsible with, that you're paying off in a timely manner, not just paying interest on. They want to see that maybe you have a car payment that you're responsible with, a property payment of some sort. They want to see a good mix in there. Not, like I said, not just all credit cards. And the credit report, this is the second part of credit that is really vitally important. And I have to say, a lot of our clients aren't really well versed on what their credit report looks like. They don't, I guess they just don't, they think they have an okay credit score, so they don't delve deeply enough into their credit report. And that can sometimes get people in trouble. But lenders look at those reports to help them decide whether they're going to lend you money. So not only are they looking at a good credit score, but they're also looking at a good credit report. And what I mean by that is they want to see a clean credit report. And we always tell our clients, get a copy of your credit report several times a year. And I'll get into that a little bit more. but make sure you don't have any errors on that. Make sure everything is in order. It's really important information. And I don't know if any of you have been in this situation, but sometimes, your credit report can be pulled for a couple of different things. Oftentimes, if you're going to rent an apartment or a home, the landlord might want to see your credit report. So it can impact your living situation. Sometimes, not too often anymore, but employers will ask for your credit report to see, just kind of get a background check on you. They can do that. All sorts of things it can be used for. Even vendors such as, your utilities might look at your credit history and your credit report to see about your ability to pay. So keep an eye on your credit report. Equifax, Experian, and TransUnion are known as the big three of the credit bureaus. They're the ones who we hear most often of issuing credit reports. They offer a free credit report once a year to anyone. And I encourage you to get one from each of these at least, well, once a year. Get it for free. It has a ton of information in it. I don't know if you've ever pulled your credit report, but it has all of your identifying information on there. And then it will go through, piece by piece what you have credit on. So say you have a Visa card, and it will show how long you've had the Visa card, and it breaks down year by year, whether you've made your payments on time, whether you've had extended debt on that credit card, any problems with the credit card, if it was closed by you or closed by Visa. It has a bunch of information on there. And it's important to check your credit report too, just to see where you stand and to make sure that everything is accurate. And that helps you monitor your credit. But the other thing too, it's very helpful in terms of monitoring fraud and making sure that everything is accurate on that report, that someone hasn't done something that you're not aware of, that maybe you didn't catch or your creditors didn't catch, but it's on the credit report. So make sure you look at that. And then, like I said, that in tandem with your credit score, your credit report, that's what they're going to look at. And I can't tell you how often we've had clients, like I've said, think, oh, I have a good credit report. We have all of their projections, their business plans, everything looks great and ready to go. And they get to the bank and they pull the credit report, and the bank or whoever the lender is sees red flags on there. So make sure you pull that before you get that close to the situation that you think you're ready to go on, maybe starting a business, and then have the rug pulled out from under you. So have that checked out. So we talk about credit scores in general, but the FICO score, that's probably the biggest one that you've heard of. FICO scores started probably about 30 years ago, and for the past 25 years ago, they've been kind of the gold standard in determining a person's credit. And FICO stands for Fair Isaacs Company. That's the organization that created it. So you want to look at your FICO score occasionally and see what it is. And you can look at your FICO score. Like, I know the bank that I deal with, there's a link on my online banking page that allows me to check my FICO score at any time. And people will say, well, doesn't that lower my credit score? That's kind of a misnomer. You can look at your credit score. The thing that will decrease your credit score, make it go down a little bit, is if you actually put in an application for credit and get denied or get approved, it will go down occasionally. So if you're shopping around for cars at different dealerships and they pull your credit report for an application, that's when your score might go down. It's not when you look at it in general. It's when the application is actually done. But FICO is great. Like I said, most companies used FICO in determining whether you're going to get a loan or not and what your score is going to be. And it's considered to be very fair, reliable, trustworthy. So FICO scores is what you really want to look at. And it's, like I said, it's the gold standard when it comes to credit scores. And just as a side note, there are other companies out there that do credit scores, and they might vary by like 100 points from what the FICO score is. So I would not use that, even if it might look better. I wouldn't use that. Your FICO score is what you would want to present to a lender. Let's see. So FICO scores, they range from 300 to 850. So the 300 is what we would consider like an FFF minus. And it goes up to an 850, which is an A+++. And if you have a score of about 740 or so, like I have on the screen, that's a very good credit score. And really, you don't have, I don't want to say you don't want to aspire to greater than 740, but if you have a 740 credit score, generally a bank is going to lend to you. Again, as long as you have a clean credit report to go with that. So they're the different ranges of credit, you know, from fair to excellent. And you want to get yourself in that the good ranges. The higher good range is even best. Once you get that 740, like I said, you're in pretty good shape with all of the lenders. So how do you improve your credit score? You know, if you're not in that good range, you know, what are the things that you can do? And just to back up a little bit, oftentimes when, especially the folks that we're working with, the lenders will say to us, we won't even look at anyone, most of the lenders, unless someone has a credit score of 620 or higher. And then again, a good credit report to go along with it. There may be some things on there that a bank will completely understand if the credit score is only 620. It's a whole bunch of things that they look at, but they really won't even consider a loan unless you have a 620 credit score. So how can you improve that credit score? When you're just starting out, one of the easiest things that you can do is maybe work with a family member. I know that's what my parents did when I was younger. I became an authorized user on one of their credit cards. So by doing that, really, as long as they have good credit history, you're going to inherit your family's good credit history. So if you have something like that you can, you know, help repair your credit, do that. Ask a family friend who might be willing to help you out to put you on their card. Kind of a tricky situation. You know, if you're going to do something like that, obviously make sure you're able to pay back any debt that you take out on their card. Otherwise, their credit will go in the hole. Pay on your credit card twice a month, which sounds very difficult to do. But even if you're paying a small amount, that second payment will go directly to the principal of the loan. So that really shows a lender that you're making a concerted effort to pay down those loans. And not only will it pay your loan down a lot faster, but you'll be paying less towards the interest portion. You'll be paying more on the principal portion of the loan. You want to maybe try to consolidate your debt. Lots of sirens go off in my head when I hear consolidate debt, because you have to shop around and do it in a responsible way and do your research. You'll see a lot of things on TV, you know, will consolidate your bills for you. And then, yes, they consolidate the bills, but then you end up with an even higher interest rate or some crazy terms in the agreement that you've signed. So just be very careful how you do that. And it can be done, whether it's a legitimate credit card company that you work with that, you know, allows you to roll over to a lower interest rate, something like that. That's fine to do, to consolidate those things rather than have, you know, 3 or 4 different big loans out there that have big interest rates. consolidating them all into one is going to look better for your credit score. And then certainly pay down your debt strategically, and that involves, if you have something that you can't consolidate for some reason, something that you can't negotiate with a lender in terms of um, either consolidating it or whatever the case may be, try and really work on that as your primary thing. Like, if maybe you have other credit cards that you will just pay the minimum on for a while, but you'll take the bulk of the money that you have in reserve, that you are able to use towards paying down this one credit card or this one credit debt that you have. Get that down to where it's much more manageable or completely off your plate. So I would prioritize your credit and how you're going to pay it down. And I don't mean to say you're going to neglect any of your credit. You can't do that. But, kind of keep the other ones going, paying the minimums, and then just really put the lion's share of your expendable cash towards this big cloud that's kind of hanging over your head. Do it that way. And how to improve your credit score, and spend less than 30% of your spending limit. They are willing. I remember when my husband and I were just when we were starting out and buying our home, and we really did not have the spending power for the mortgage that they approved us for. They were approving us for like a $400,000 house, and this was over 25 years ago. Trust me, we did not have the money. I suppose if we didn't do anything else with our life, maybe we could have done it, but you don't want to use your entire limit that they give you. You want to live within your means. Oftentimes it's easy. You see that you have that money that's there to spend, but don't use that. If you do need to use the full amount on your credit card, there is one way to get around this. On your credit card statement that you get every month, it will show the billing cycle, from a start date to an end date. That's the billing cycle. That end date of the billing cycle is actually what's called the statement date. And so on that statement date, that's when the creditors will report your activity on your credit card to the credit bureaus. So if you have an emergency situation and you have to max out your credit card, maybe you're traveling somewhere and something happened and you need to just max that out. Well, as soon as you can, try and pay it off before that statement date is done. And essentially the credit bureaus will never know about it because you will have paid it off. Now, just to point out, your statement date is different than the due date on your credits on your credit card statement. The due date is when the company wants the payment, but the statement date, that's the date that, like I said, the credit card company is going to report your activity to the credit bureau, and they're the ones who finagle your credit score. So you can do it that way. So paying off the credit card before it's reported, that's key, and really watching your spending limit. Live within your means, and as my dad always told me, live below your means. That's the best way to get ahead. So if you do have a good credit score, a couple things that you want to think about: never get close to your credit spending limit. Even though that money is there and you've been approved to spend it, the banks, again, just want to see that you're a responsible credit holder. It's there in reserve if for some reason you need it, but they really don't want you to spend it. The only ones who really want you to spend that are the credit card companies, because they want to see you get in over your head, because that's how they make money. If people don't do that, then they're going to go broke. So don't get sucked in to spending more than you can really afford. So spend just about 30% of what your credit limit is. And I have the example of there of, $300 if you have a $1,000 credit limit. Again, to maintain a good credit score, if you can do it, pay off your debt in full every single month. The more you can do that, the quicker your credit score is going to rise. And we tell people, especially if you're just starting out and you get a credit card, charge something that's, $25 and pay it off in full the next month and continue to do that for several months. That shows that you're very responsible, you're building your credit, and you're maintaining that credit. And, that keeps you in good stead with all of the lenders if you do something like that. And one misnomer that I just wanted to point out on this. Some people we have heard say to us, well, I want to leave a little bit of a balance because they've heard that that's good, keeping a little bit of a balance on a credit card. It's not. Keeping your credit card or your credit active is important, but that's a lot different than keeping a balance. As I said, if you buy something 1 month and then pay it off in the same month, that's a good thing. You're keeping your credit card active. But keeping a small balance on the credit card, some people think that they need to have that balance to keep a credit card open. You don't need to do that. So get rid of that misnomer, and that will help you maintain that good credit score that you've achieved. Does your business have a credit score? Yes, it does. Similar to your personal credit cards, the best thing you can do to build a good credit score for your business is to make payments on time to your creditors. Businesses use a bunch of different algorithms. They don't follow one specific industry standard like FICO does, and it really varies from the different credit bureaus who collect credit scores for businesses on what that algorithm is. But generally, the business credit reports include just the accounts that you have under your company's name and not your personal accounts. However, small business lenders and credit card issuers will still take a look at your personal credit as well if you're going to take a significant loan from them. So it's very important to establish credit for your small business. And I frequently tell this story when I'm talking about credit. We had some clients who owned a daycare center, and they purchased the daycare center. It was an operating daycare center on a payment plan. And so they were paying the previous owner on a monthly basis for the business that they bought. And they were paying cash. They were using all of the money that they received from tuition and their enrollment fees to pay off the business. Well, the problem with this was that the loan that they entered into had a balloon payment at the end. So what that meant, after several years, there was one big payment that they would have to make after, I think, I want to say it was year 10, to the former owners of this company to pay it off. Well, as year 10 was approaching, they were realizing that they hadn't reserved enough money to make that balloon payment. They were paying everything monthly on time with the cash that they were getting, but they never put money aside. So now they came to us to work with us to see if we could help with them getting a business loan to help pay off the business. Well, long story short, they thought they were being very responsible and good business owners, and they never established credit. If they needed to buy, snacks for the daycare, they paid cash. If they needed to buy new furniture for the daycare, they paid cash. Everything was a cash transaction, which sounds great. They thought they were doing everything the right way. They weren't incurring debt. They thought they were great. But now they've come to this point and they have a big loan that they need to pay off, and they can't get a loan because they don't have established credit. So we we tell our clients all the time, start by opening a credit card or or even taking a line of credit somewhere, and pay it off monthly. Buy your juice boxes on your credit card and pay it off. Do those types of things. And that really establishes credit for a business. So, yes, you do want to do that. And payment on time to the creditors, just like with personal credit, is key. For business credit reports, there are three major credit bureaus, similar to personal. Experian and Equifax are also in this game, but Dun & Bradstreet is one of the big players, especially for larger companies when you look at business credit reports. And it's important too to keep an eye on your business credit, making sure you have a clean credit report and a good credit score. And like I said, they all calculate these things a little bit differently, and I'm not going to go into a ton of information on it. But the one thing that I think is interesting for any business that has a Dun & Bradstreet number, all the information is public. So anyone who wants to see your credit history and your score can go in and do that for a fee. Now, granted, it's a little expensive, but I think it's $185 or $89. And then I think it's like 40 some dollars for Experian and Equifax, but keep an eye on those things. So a lot of people wonder, do I really need a credit score for my business? And if your business is just getting off the ground, if you're a newbie, you're probably going to be using your personal credit initially to get financing for your business. And if things are going smoothly, you might wonder, like, why is it necessary for me to establish a separate credit for my business? But as I just mentioned in that example, things come up, you don't know what the future is going to hold. So having some credit for your business is, I think, a very important thing to do, especially if you want to expand, or if you find yourself in a situation like we did this past year that you need to borrow, it's going to be important for you to have. Also, if your business has its own credit score, it really does separate your business from your personal finances in a much more defined way, having your personal credit score and then your credit score for your business. That makes a lot of sense as well, to have that separated. Also, the other thing that helps too, when you have a good credit score for your business, not only is getting financing easier, but a lot of the things that you buy for your business, whether it be insurance, loans, equipment, anything like that, you're probably going to be looking at lower rates for all of those things. So that's a good idea to make sure you have that. And then, like I said, as you increase that business credit score, if you have, especially if you from the get-go kind of have a growth plan in place, you're going to want to have that score so that you can expand appropriately and do what you want to do. Each of the three credit bureaus have a different way, like I said, of figuring out your credit worthiness. And I don't want to go into too much detail, but they look at all sorts of things, but they primarily look at information from at least 4 of your vendors, people that you buy supplies from. And they look at different trade associations that you might belong to. And of course, the use of your credit cards and how you're paying things off. So all of that information about your payment to your creditors and vendors, etc., gets reported to the credit bureaus. Oftentimes, it's done through a third party, and that can, they say it's all verified, but quite frankly, you need to check it yourself to make sure all of the information that third party is reporting to any of the credit bureaus is correct. And it's not so hard to do. You can pull credit reports on your business just like you can for yourself. For Dun & Bradstreet, they kind of have a 4-tier credit rating system, and it measures the overall strength of your business. And I don't know if you folks are in business or not yet, so I won't dwell on it too much, but they have their D&B credit rating, which measures the overall risk of your business. Then they calculate something called Paydex, which is the speed of payment for, how quickly you're paying back your debt. Your delinquency predictor score, your likelihood of not paying or late payments or the likelihood of bankruptcy. And then your supplier risk rating, which is what are the odds of your business surviving over the next 12 months. So their stuff is a little bit more doom and gloomy. It kind of really puts things in perspective, I suppose. But that's what Dun & Bradstreet will look at when they issue a credit rating for your company. Just wanted to check, make sure I didn't have anything with that. So Equifax, they do the same type of thing. They look at the timeliness of payments. They look at the likelihood of your business becoming delinquent and the likeliness of your business closing in the next 12 months. So they have a 3-tiered approach. They look at all 3 of those things when they create their credit score for your business, but that's primarily what they're looking at. Again, keeping on top of things, whether it's for personal or for business credit, is the key to maintaining good standing for your finances. Experian, same type of thing. They have their credit score report that they issue, and it's comprised of the 4 things of your business credit score, payment trends that they've seen with your creditors and your vendors, your account histories and how they've changed over time or fluctuated in any way, good or bad. And they look at public records as well. Any reports that they've had from vendors or third parties in terms of difficulties they've had working with you, non-payments, those types of things. They kind of almost like a character analysis of some sort is what they look at. So I kind of went through that quickly. Any questions that you guys might have for me? I'm happy to try and answer anything that you have.
There is a question up in the chat box, Dorothy.
Okay.
They're
And I
asking
don't know. Go ahead.
if you apply for a mortgage loan with another individual or 2 individuals, what score does the lender use?
They will look at all of them. They will look at each of those persons' credit scores and their credit reports. And honestly, the weakest link is going to bring you down in a situation like that. If you have several people applying for, excuse me, a loan of any sort, you might have 2 that are really good, but that third person is, not looking so good. That will knock you out of the park for eligibility for a loan, or at least, put you in a different category that you have a much higher interest rate. So before I would do something like that, I would really try and work with that third person or the second person and try and excuse me, assist them in improving their credit score. And the same goes for business loans. We've had that situation happen several times when people, you have a group of partners wanting to start a business and pardon me, most of them have good credit reports and scores. Then they find out one of their partners does not, and they're eliminated from getting financing. So in that situation, it's either, do you kick the partner out and just have them as an employee, or do you work with them and hope that they can improve their credit score? The other thing that I should mention too, if you're having a really difficult time and you need a little bit more one-on-one time with improving your credit, and I should have pulled it up, but Consumer Credit Counseling is a government group. They're located in Pittston, and I want to say William Street, but I'm not 100% certain. But you can go to them and work with them, and they can help you improve your credit score. We have seen some of our clients who have had some issues go to them, and really within a couple months, they've seen improvement in their credit scores. So they do a really nice job. Their services are free, it's legitimate. They will help you down the right path to repairing that credit score. And that's Consumer Credit Counseling. Anything else?
Question in the chat box. When is it better to close a dormant credit account with a high credit limit versus closing it? If considered too high of a credit risk, meaning could spend too much, though have not.
Well, I missed the first part of that, Jolene. What is it?
When is it better to close a dormant credit account with a high credit limit versus closing it? In parentheses, if considered too high of a credit risk, meaning could spend too much, though have not. I'm a little unclear on that. I don't know if you want to
Yeah.
unmute Jenny.
Well, I mean, honestly, you can leave it open. If it has a high, there's no harm in really keeping it open. You might occasionally want to activate it, like I said, charge $25 on it if you want. But if it's something that you don't think you're really ever going to use and you have enough other credit cards, by all means, close it. I don't want to say it doesn't matter, but that won't really impact your score too much. Like in doing this report, I pulled my own credit report because I thought, I don't want to be not practicing what I'm preaching. And I looked at mine, and I have quite a few open credit cards from forever ago. I honestly don't even remember opening them. Maybe my husband did it. Maybe he wanted it. Who knows how they got there. But anyway, they're there. They're open, and my credit score is still very good. So it hasn't impacted me negatively in any way. I don't know if that answered your question. It was a little confusing.
I included in the chat box the address and phone number for Consumer Credit
Oh,
Counseling.
thank you. Thanks. Anybody else have anything? And one thing that I'll just leave you with, I mean, if you're thinking about a business loan, I don't know if that's what anyone is contemplating, why they attended this. And this is probably a seminar for another day, but we often talk about the 5 C's of financing. I don't know if you're familiar with that. And, a big part of that is your credit score and your credit report, your character, meaning, are you well informed on the business that you're opening? Are you an upstanding citizen? They look at cash flow, they look at collateral, and they look at, what am I missing, Jolene? Cash flow, collateral. Oh my gosh. I literally do have COVID brain, people. I can't think. I know this like the back of my hand. But anyway, what I was going to get at is there are those 5 C's of financing. And, people often come to us and say, oh, I'm good on 4 of them. I'm a little shaky on having the collateral. Or one of the things that I forgot is, having capital to put towards the project. That was the 5th one. Maybe I don't have the capital. It doesn't work that way. They want to see all 5 C's of financing met. So making sure you have all of those together. So people don't understand how important their credit score is until they get turned down by a lender because they're just not quite there or they don't have a great credit report. And we always say, get your ducks in order before you go for financing, whether it's for a personal loan, for that mortgage, or before your business loan. You will be far better off down the road if you have that done on the front side than struggling with it while you are working through starting a new business. It'll be very tough. Anything else? That's a good question. Yeah, it's just the same as cash. The question was, does making a purchase with a business debit card help establish business credit or count as cash? And it really is just like using cash. It does not establish credit. So you want to get a credit card, not a debit card for your business. And, shop around too. You can find especially right now, the market's pretty competitive for credit rates. So sometimes even through your credit unions, you can get credit cards that have good rates. Some of the big box stores have good credit rates. I know at one time, I think my husband opened I think it was a Lowe's credit card. It was a low interest rate. We were using Lowe's a lot, and that was a good way to help us establish credit. He'd go in and buy, I don't know, paint stirrers or something every once in a while that costs like $15. We paid it off, and that helps establish your credit. So do those things. Anything? Looks like there's. I don't know why my chat isn't.
Oh, there was a comment as a follow-up from the question before.
Oh,
They heard that closing a credit card can lower your score and too great a limit can be considered a risk.
well, I mean, it can help. If you have like a bazillion old cards out there that are inactive, yeah, I'd probably close them. And too great of a limit can be considered a risk. I don't believe that's true. I mean, just personally speaking, I have several cards that, have a high credit limit on it. I haven't used them in years. I choose to keep them for a just in case scenario. But it hasn't impacted at least my score negatively. I've never heard it impacting anyone's negatively. Unless there's more to it, like with terms or something that I don't know about for a particular credit card. But no, it should not impact you that way negatively. If you have a card open and it has a high credit limit on it, that shouldn't factor into anything. If you have a credit card open and you've hit that credit limit and you're not paying on it, that becomes a problem. But no, leaving it open without activity shouldn't be an issue. Did I miss one, Jolene?
I don't think so. I just
Okay.
internet got kicked out, so
Okay.
I think you answered all the questions in the chat, though. If there are no more questions, we can go ahead and wrap up.
My final word is resist temptation. Maybe you want the Mercedes, but for a while you have to settle for the I don't know, the Volkswagen or something like that. Yeah, I've done my share of that, but it pays off in the long run. So, like I said, live within your means, build it slowly, and it will open a lot of doors for you. So, just keep on top of your credit and check that credit report frequently to make sure everything looks good.
Looks like we're going to have one final question somewhere in the chat.
Trying to see.
What do you do if disputing a bill that is hindering credit scores that you do not feel is correct?
Right. And well, I think obviously that's key. And honestly, I don't know the details of a lot of that. obviously raising a dispute, I believe that that dispute does show up on your credit report, that you are disputing it as, oh, that's so funny that you would say that, exorbitant medical bills that aren't correct. That's one of the issues that we have seen lenders, I don't want to say overlook, but I would say take into consideration, because it happens frequently. People get bogged down for either legitimate or illegitimate medical bills, meaning that, they know that their insurance is going to pay for it, but, something got lost in, how the billing was done. But the fact that you have a dispute in is number one. But that's an issue that I would probably chat with consumer credit counseling about to see how they can help you eliminate that from your credit report and score, while it's going through the process, because I'm sure there are ways to do it. I am not well versed enough to answer that. They would have a better answer for you. Anything?
All right, well, if there are no more questions, we'll go ahead and wrap up. I have just a few housekeeping notes for everyone. I will be making available the recording of the training on the Wilkes SBDC YouTube channel, and I'll email that link to all attendees after this session. I'll also be sending out a post-event survey so that we can determine which of our resources will best suit your needs and what topics you'd like to see in the future. And finally, we have a new webinar on April 14th at 5 p.m. titled Basic Bookkeeping for Small Businesses. So if you're interested in that, you can sign up for that through the eCenter. And with that, I want to thank everyone for attending this training. And if you have any questions, please don't hesitate to contact us at the SBDC. I hope that all of you have a wonderful rest of your day, and I look forward to seeing you at future webinars. Thanks, everyone. Bye.